Preparing for a financial analyst at American Express interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How does American Express make money, and what financial metrics would you monitor as a financial analyst? Answer. American Express makes money primarily through interest on revolving balances, fees from cardholders, and transaction fees charged to merchants. As a financial analyst, you would monitor key metrics such as revenue growth from loan balances, changes in non-interest income, net interest margin, delinquency rates, charge-off rates, and return on average assets. American Express is a global payments and financial services company. It earns discount revenue from merchants, card fees, net interest income, and other service fees. For a financial analyst, I would monitor billed business, average discount rate, card member loans, revenue net of rewards, provision for credit losses, operating expenses, and customer acquisition efficiency. The key is linking volume growth to profitability, because higher spending only creates value if credit, rewards, and servicing costs are controlled. While answering, focus on American Express revenue streams, card member spending, merchant discount revenue, lending economics, credit losses, rewards costs, expense control, and how operating metrics connect to profitability. Question 2. Walk me through how you would build a monthly forecast for card member spending revenue. When I build a forecast, I start with drivers, not just historical percentages. For card spending, I would segment billed business by product, customer cohort, geography, and merchant category. Then apply assumptions for growth, discount rate, rewards, and credit trends. I would compare outputs to recent actuals, macro indicators, and business partner input. Finally, I would show base, upside, and downside cases so leaders understand which assumptions move earnings most. Make sure to cover driver-based forecasting, historical trends, segmentation by product or customer type, macro assumptions, business partner input, scenario analysis, and validation against actual results. Question 3. You find that actual revenue is below budget. How would you perform and explain the variance analysis? A strong variance story separates price, volume, mix, and timing. If revenue is 5% below plan, I would first compare actual billed business, discount rate, loan balances, fee income, and rewards costs against budget. Then I would identify whether the gap is structural or timing related. I would summarize the impact in dollars, explain the main drivers, and recommend actions such as revising assumptions, targeting underperforming segments, or adjusting expense plans. In your answer, talk about isolating drivers such as volume, rate, mix, timing, one-time items, customer behavior, and communicating the story clearly to senior stakeholders. Question 4. What is the difference between billed business, discount revenue, net interest income, and total revenue at American Express? Billed business is the total amount card members spend on American Express cards. It is not revenue by itself. Discount revenue is earned when merchants pay American Express a fee on that spending, usually expressed as a discount rate. Net interest income comes from revolving card member loan balances after funding costs. Total revenue includes discount revenue, net interest income, card fees, travel commissions, and other fees, adjusted for rewards and customer incentives where applicable. Be sure to mention that billed business is spending volume. Discount revenue comes from merchant fees, net interest income comes from lending balances, and total revenue includes multiple components. Question 5. How would you evaluate whether a new card member acquisition campaign is financially attractive? I would evaluate the campaign through lifetime value versus acquisition cost. For example, if we spend $200 to acquire a customer, I would estimate annual spend, discount revenue, card fees, rewards expense, servicing cost, expected credit losses, and retention. Then I would calculate payback period, net present value, and sensitivity to lower activation or higher attrition. A campaign is attractive only if it generates risk-adjusted profit, not just account growth. While answering, focus on customer lifetime value, acquisition cost, activation, spend behavior, revenue net of rewards, credit losses, payback period, retention, and risk-adjusted profitability. Question 6. How do provisions for credit losses affect the income statement and forecast? Provision for credit losses is an expense that reflects expected losses on card member loans and receivables. If delinquencies rise where the macro outlook weakens, reserves may increase, reducing pre-tax income. In a forecast, I would model loan balances, write-off rates, recovery rates, and changes in reserve assumptions. For American Express, credit quality is critical because growth in lending revenue can be offset quickly if losses accelerate. Make sure to cover expected credit losses, delinquency trends, reserve builds or releases, impact on pre-tax income, macro assumptions, and why credit performance matters for a card issuer. Question 7. What financial model controls do you use to make sure your analysis is accurate? I use a disciplined model. In your answer, discuss clean model structure, separate inputs and formulas, checks, version control, audit trails, reasonableness tests, documentation, and review with stakeholders. Question 8. How would you analyze operating expense growth that is running ahead of revenue growth? I would first separate structural cost increases from temporary timing items. Then I would break expenses into categories such as headcount, marketing, technology, servicing, and vendor costs. If expenses are growing faster than revenue, I would assess whether they are tied to future growth, regulatory needs, or inefficiency. The goal is not automatic cost cutting, it is understanding which costs drive value and which create margin pressure without clear business benefit. Be sure to mention fixed versus variable expenses, controllable costs, investment spending, productivity ratios, headcount, vendor spend, timing differences, and whether higher costs support future revenue. Question 9. What happens to American Express profitability if the average merchant discount rate declines? A lower average discount rate reduces discount revenue per dollar of card member spending. The total impact depends on whether lower pricing also drives higher merchant acceptance and spending volume. I would quantify the revenue loss using billed business times the rate change, then test whether incremental volume offsets it. Management could respond through premium customer engagement, better merchant value propositions, cost discipline, or mix shift toward higher yield products and segments. While answering, focus on discount revenue sensitivity, merchant pricing pressure, volume elasticity, competitive dynamics, premium customer value, expense offsets, and how management might protect margins. Question 10. Tell me about a time you had multiple finance deadlines at once. How did you prioritize? I would answer this with a clear star example. In one reporting cycle, I had a forecast update, variance deck, and ad hoc leadership request due in the same week. I ranked deliverables by business impact and deadline, aligned expectations with stakeholders, and created checkpoints for review. I automated part of the variance file to save time. The result was that all deliverables went out on time, with no material rework. Make sure to use a star structure. Show prioritization under pressure, stakeholder communication, quality control, realistic timelines, and how you protected accuracy despite competing demands. Question 11. Describe a time you used data to influence a business decision. A strong example should show that analysis changed an outcome. I once reviewed product-level profitability and found one segment had high revenue but weak contribution after incentives and servicing costs. I built a customer cohort view, showed the margin gap, and recommended shifting budget toward a smaller but more profitable segment. Leadership adjusted the campaign mix, which improved payback and reduced wasted spend. The lesson was to analyze profitability, not surface-level growth. In your answer, talk about the business question, data sources, analytical method, insight found, recommendation made, and measurable impact on revenue, cost, risk, or process efficiency. Question 12. How would you improve forecast accuracy for a business unit with frequent misses? I would begin by measuring where the misses occur: volume, rate, expenses, timing, or one-time items. Then I would compare forecast assumptions against actual outcomes over several cycles to identify bias. I would partner with business owners to refine drivers, add leading indicators, and create a rolling forecast process. Forecast accuracy improves when assumptions are transparent, ownership is clear, and misses are treated as feedback rather than just errors. Be sure to cover root cause analysis, driver accuracy, forecast bias, business partner accountability, rolling forecasts, scenario planning, data quality, and comparing assumptions against actuals. Question 13. Explain the relationship between revenue growth, operating leverage, and earnings growth. Operating leverage means earnings can grow faster than revenue when a business scales over a cost base that does not rise proportionally. For example, if revenue grows 8% while expenses grow 4%, margins expand and earnings growth accelerates. But the opposite can happen if rewards, credit losses, or acquisition costs rise faster than revenue. For a financial analyst, the key is evaluating revenue quality and whether incremental growth actually drops to the bottom line. While answering, focus on fixed versus variable costs, margin expansion, scalability, expense discipline, revenue quality, and why earnings can grow faster or slower than revenue. Question 14. What sensitivities would you include in a forecast for a payments and card business? I would sensitize the forecast around the drivers that matter most to earnings. For American Express, that includes billed business growth, average discount rate, card member loan growth, funding costs, credit loss rates, rewards expense, marketing efficiency, and customer retention. If the business has international exposure, I would also test FX. Sensitivity analysis helps leaders see which variables create risk and where management actions could offset downside. Make sure to discuss spending volume, discount rate, loan balances, interest rates, credit losses, rewards costs, customer attrition, FX, marketing efficiency, and macroeconomic assumptions. Question 15. How comfortable are you using Excel, SQL, or BI tools in financial analysis? I am comfortable using Excel for modeling, variance analysis, and scenario work, including pivots, lookups, index match, and structured formulas. I have used SQL to pull and join data, filter transactions, and create repeatable datasets. BI tools are useful for dashboards and trend monitoring. The important point is not the tool itself. It is using clean data to answer a business question quickly and accurately. In your answer, talk about specific tools, practical finance use cases, data cleaning, joining datasets, building dashboards, automating recurring work, and translating analysis into business recommendations. Question 16. A business leader asks you to find cost savings without hurting growth. How would you approach it? I would avoid across-the-board cuts and start with cost transparency. I would categorize spend into growth investments, mandatory costs, operational run rate, and discretionary items. Then I would analyze ROI, utilization, vendor contracts, duplicate tools, and process inefficiencies. Savings should come first from low-value or underused spend, not from areas that drive customer acquisition, compliance, or service quality. I would present options with savings, risks, and implementation timing. Be sure to mention cost categorization, ROI analysis, benchmarking, low-value spend, vendor review, process efficiency, protecting strategic investments, and presenting practical trade-offs. Question 17. During month-end close, you notice a material number does not tie to the source report. What do you do? I would first confirm whether the issue is a timing difference, mapping problem, formula error, or source data issue. I would trace the number back to the underlying report, quantify the variance, and assess materiality. If it affects reporting, I would escalate quickly with a clear summary and proposed fix. I would document the resolution and add a control to prevent recurrence, because close accuracy matters more than simply finishing fast. While answering, focus on reconciliation discipline, source data checks, escalation, documenting findings, correcting root causes, maintaining close timelines, and balancing speed with accuracy. Question 18. How do you explain complex financial analysis to a non-finance audience? I start with the decision the audience needs to make, then explain only the financial drivers that matter. Instead of saying unfavorable variance, I might say revenue is below plan because transaction volume declined in 2 customer segments. I use simple visuals, bridge charts, and clear dollar impacts. The goal is not to prove technical skill, it is to help business partners understand what happened, why it happened, and what action to take. Make sure to cover audience awareness, business language, avoiding jargon, highlighting the key takeaway, visualizing drivers, using examples, and linking analysis to decisions. Question 19. American Express values collaboration and customer commitment. Tell me about a time you worked cross-functionally to solve a problem. I would choose an example where finance partnered with operations, marketing, or product. In one case, a reporting issue caused confusion over campaign performance. I brought finance, analytics, and marketing together, aligned definitions, rebuilt the performance view, and clarified the drivers. The solution improved trust in the numbers and helped the team make faster decisions. That fits American Express because strong finance work supports colleagues and ultimately improves customer outcomes. In your answer, use STAR. Highlight teamwork, influencing without authority, listening to partners, resolving conflict, customer or stakeholder impact, and connecting behavior to Amex culture. Question 20. Why do you want to work as a financial analyst at American Express? I am interested in American Express because it combines a premium brand, payment scale, lending economics, and customer loyalty in one business model. The financial analyst role appeals to me because it is not just reporting numbers. It is connecting data to decisions on growth, cost, and profitability. I bring strong analytical discipline, communication skills, and curiosity about business drivers. I want to help leaders make better decisions with clear, accurate financial insight. Be sure to mention genuine interest in American Express, payments, and premium customer economics, analytical problem solving, business partnership, culture, and how your skills match the role. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.